Now, what we saw last week was almost like a gut-wrenching sell-off in US big tech. US big tech, which is Amazon, Meta, earlier known as Facebook, Alphabet, earlier known as Google, some of these stocks, they make up the big tech. This, in a sense, has been the most cozy and the most overcrowded trade in last 10 years. 10 years ago, if you just made a basket of the FANG stocks, as they were popularly known as at some point in time, you've made crazy returns. But that trade has reversed. The difference is that these are growth companies. And when growth, in a sense, takes a back seat, some P multiples, they, in a sense, in the near term, they get rebooted. But these companies, unlike startups, are cash generating machines. But yet the sell-off in an Amazon or a Alphabet or a Microsoft has been absolutely devastating. But what does that mean for Indian companies? Are we comparing apple and oranges? Or if something happens to the big tech, which are cash generating companies, it will have an impact on the entire it will have an impact on the entire global growth stocks. Let's discuss that and let's take that debate forward with Vikas Khemani and Moshe Katri. Vikas, Moshe, good morning to both of you. Thank you for joining us. If I compare the sell of Vikas in global tech stocks and correlate that to what is happening in India, am I comparing apple and oranges?
Because I think the answer also is there in your question that both are two different sort of segments. Both are having different drivers of the growth. If you look at last 10 years, the entire big tech in US grew significantly, but that was not the growth platform in our IT services company, right? So I think both are very very different sector segments in some sense. Most of the US big tech companies have a direct consumer related sort of growth, whereas most of the IT Indian services companies are B2B businesses catering to those businesses, and that too also across sectors and segments. And the game for Indian IT services companies changed post COVID with the acceleration in the digitization and cloud migration, which was earlier happening, but the pace and acceleration completely changed. And I think that is the key driver of the growth for the Indian IT services companies. And that, in my opinion, is not dependent on what's happening. And of course, big tech companies will have a part of the consumption from the Indian IT services companies, no doubt about it. But unlikely to have very major bearing on that. If major slowdown happens, it will have some impact out here as well. But it's not that their growth is solely dependent only on big tech sort of companies' performance specifically in the share market. Because I think most of these companies would consume IT services and Indian IT services do offer cost savings advantage as well. So I would tend to believe that whatever setup of Indian IT services is very different than US IT, and in fact some of the things which is set to change for Indian IT services company, including attrition coming down, currency, all those things will work well for Indian IT services company in medium term.
Okay, so Indian IT software companies are very differently placed than the global tech as well. Moshe, let me bring you as well into the discussion. There are two parts to the entire correction that we have seen globally as well. One is, of course, that the valuations have corrected on account of the interest rate upcycle and the DCF valuation that we have seen. And the second part is the fact that earnings downgrade have also happened. Do you think we've already seen the worst of the earnings downgrade, or this is just the beginning of that, given that commentary from a lot of these tech companies are quite subdued for next year as well?
It's a great question. I wish we all had a crystal ball, right? So I think the response to your question is it depends. It seems that a lot of the earnings reset or the earnings downgrades, as you call it, for next year seems to be factoring maybe a soft landing more than anything else. But having said all that, it just feels that the tech correction we've seen so far this year and the volatility almost uses the 2008 market crash playbook. Without any regards to the actual numbers that we've seen this year and even this quarter that have been actually spectacular. As you know, I cover IT services, but I also cover payment stocks. So I cover a lot of the payment processing companies that have a view, not only, so obviously on the IT services side, we have a view into IT spending and IT budgets, but on the payments side, we have a view into consumer spending. I mean, obviously you always have some pockets of weakness, but the numbers are really holding up well. So, barring what happens during the next quarter or two, really depends on what sort of assumptions we have to kind of bear into 2003. And this is where you have to wear your hat as an economist, and you have to make those assumptions in terms of soft versus hard landing. A hard landing scenario means that multiples will go down to 11, 12 times earnings. As you know, we're not there as of yet. So there's definitely more to go in terms of weakness. A soft landing seems to be kind of embedded in a lot of these names right now.
Vikas, let's address the stock market investor here. The stock market investor likes the big picture for Indian IT. We know that if the world is contracting, Indian IT companies will grow. But in markets, there is a cycle which is at play. And if US big tech stocks are getting smoked, if growth stocks are taking a back seat, do you think Indian IT stocks, despite the recent rout of underperformance, they are unlikely to come back up? And for Indian IT stocks to come back up, globally growth stocks have to make a comeback?
So I really, necessarily don't think so. For the simple reason, of course, anything happening in the, in the developed part of the world will have an implication. There's no question on that. Because ultimately we are all dependent on the demand is dependent on that as part of the economic growth. But having said that, like for the reasons which I mentioned, that some part of the demand is non-discretionary, some part of the demand is deflationary, which helps companies save cost. And if given the kind of labor market which is there in the US economy, I think some part of the outsourcing is inevitable. And as a result of that, I feel some of the challenges which IT companies faced in the last few quarters, including heightened attrition, which I think put pressure on most of the IT companies. Nikun's important point is if you look at the quarterly earnings this quarter, most of the companies had a decent order wins. Now just think through that if any CEO or any large organization is giving a large contract, he is doing that knowing very well that the recession could be in offing. Today that scenario is very well known to everybody who's giving a contract. Now if that scenario, in that scenario also, if your order wins and total contract value are robust and growing, it clearly gives you a bit of indication that what is it in store. So according to me, that order book is a very order wins are very lead indicator of what is coming in the sector in next 3, 4, 5 quarters. So I feel most of the IT sector stocks are offering very good risk reward. They are defensive in nature, 3 to 4% dividend in many IT stocks, and and also a reasonably good hedge against the currency. So I would say that one should not be very worried. In fact, right now the current high of pessimism in the IT sector could be a good opportunity.
Moshe, you made a very interesting point that while you track tech, you also track the payment side. So coming to that, and one basic question that a lot of people have, $400 billion wiped off from big tech last week, $3 trillion in market capitalization for the full year. Is it still an expensive space? We just heard what Vikas has to say from the Indian market's perspective. Is it still a very expensive bucket?
There are two buckets here to focus on. Some of the companies that generate a significant amount of free cash flows, they're growing revenues, they have decent margins, and they have pretty strong pricing power. And these actually are looking pretty interesting. So we cover the networks, MasterCard and Visa. We cover some of the merchant processors that are trading at 10, 11 times earnings. These look great. On the flip side of it, we also cover some of the names that are kind of not really making money on a GAAP basis, if you will. Look at Block or Square, trading at I don't know, based on non-GAAP earnings, is trading at 38 times next year's numbers. So there are buckets where you can actually own some of the names just because they're inexpensive and their characteristics look very appealing in this market. They're defensive, they're low beta. So, it depends on which bucket you're kind of looking at. I just want to add one more thing about your last question, looking into the fundamentals of IT services. So we went through multiple cycles of market downturns in the past 15 years. So while demand looks good now, while bookings are robust, I always tell my investors that backlogs and bookings are not engraved in stone. They can be paused, they can be canceled, they can be terminated. So, at least for now, we're in good shape, but things can really change based on the macro looking into next year in terms of, bookings, booking conversions, and all that stuff. All these things can change. And that's why I think this is why you have all this uncertainty out there.
Okay, so let's see how all of this pans out. It is a down cycle, a global re-rating that we're seeing when it comes to P multiples of tech, a cascading impact that's also expected in India that we've started to see signs of. Thank you, gentlemen, for joining us today on the show.